There's an old adage that says, red skies at night, sailor's delight. But when it comes to trading, red charts during the day equal stock traders' dismay. That was certainly the case heading into Labor Day weekend. But how did I do? In this video, I want to discuss my 25K challenge from the patterns I spotted to the high probability trades that were created, the entries and exits, and most importantly, the results. So let's unpack this video and get started. Hey Optionetics Power Profit Trade members, welcome to Tom's Trading Room, where we offer analysis, insight, and step-by-step comparisons of alternative investments other than just buying stocks. Do me a favor right now, and I want you to hit that like button below as it helps support the channel. Also, if you click on the subscribe button and ding that bell next to it, we'll notify you as soon as a new video is uploaded. So over the last couple of weeks, I've been talking about the fact that the markets typically move higher into the Labor Day weekend. It's actually happened 9 of the last 10 years. I've also been talking about technical moves and how not only the stock market, but very strong stocks, as they hit 52-week highs, tend to move higher the next week as well as the next month after those highs have been hit. All right, so I put together a strategy and I called it my 25K challenge with everybody, and I told you I was going to talk about this last week. I've been posting on the YouTube channel on the community board showing you day by day what's been happening. Well, I decided to end it all early because of what happened in the markets, because that's what good traders do. They don't let profits turn into losses. So I want to unpack everything right now. So let's talk about this and get started. All right, so my 5-day trading strategy looks like this. I saw my money calendar saying that we had bullishness going into the market through the Labor Day weekend. That was number one. I also suggested that 52-week highs were going to help lift certain stocks well into the Labor Day weekend. So all I did was I put two strategies together that were both bullish. The third thing I did was I looked at the option prices themselves, and I found actually some surprising results. Options on most stocks right now are higher than they were weeks ago when the stocks were actually lower. This is not something that occurs all the time. And so what I did was I took these, what I call the Fat G stocks, not FANG, Fat G, F-A-A-T-G, Facebook, Apple, Amazon, Tesla, and Google, right? These 5 stocks were in the top 6 of securities that were hitting all-time highs, 52-week highs, day after day after day. The only other thing that was on here that was hitting was the S&P 500. So I took Facebook, Apple, Amazon, Tesla, and Google/Alphabet, and I put 1-week trades on them. Now, I turn the question to you. What's the best strategy when you have, number one, a bullish market setup? That's the overall market historically moving higher into the holiday weekend. Number 2, bullish trade setups looking at the trend as your friend and 52-week highs equaling higher highs, but then adding number 3, high option volatility. I don't like buying things that are expensive. In fact, I'd rather sell them. So if you take bullish market setup, bullish trade setup, high option volatility together, what do you get? Put selling strategy. So let me explain what put selling is all about. Put selling is a bullish strategy where we are obligating ourselves to buy the stock at a strike price. We're getting paid for that obligation. So as an example, if I were to look at a bullish strategy using XYZ, and let's say XYZ is trading near $100 a share, I could buy the stock. 100 shares of stock at $100 a share is going to be a $10,000 out-of-pocket cost to me. But I could also sell the put options, which would obligate me to buy the stock if we were at or below that strike price at expiration. I'm going to get paid $10 a share for that obligation. So in this case, I can bring in $1,000 selling one XYZ put option at $10. So now my cost, if I get put the stock, is no longer $10,000. It's $10,000 for the stock, but I took in $1,000 for that obligation. Now, what put sellers typically like to see is their put options go down in value so that they can sell high and either buy back low or not buy back at all, looking for that to go to zero. Risk, we know, is the stock price. Reward is going to be the actual maximum reward is the amount you take in. The break even on this trade is going to be your strike price minus what you took in. So it's like you get the stock not at $100, but 100 minus 10 is 90. So you're actually getting it below market price. Exiting this strategy, if you sell puts and they're out of the money or at the money on expiration day, the options will expire worthless. There's nothing to do. If they're in the money on expiration day, the option could get assigned as long stock unless you buy to close the puts. And most people, when they do an option transaction, whether they're buying calls, buying puts, whether they're selling puts, typically they reverse the trade and close out of it long before expiration. If you sell puts, keep in mind that this comes with margin. And the margin on most puts is typically about 20% of the strike price. Now, that's typical. Check with your broker to see what they actually do for you. Okay, so remember my trades? I sold puts on Fat G. I took in roughly $25,000 in premium. What I did was for Facebook, Apple, Amazon, Tesla, and Google, I took in about $5,000 each on those out-of-the-money puts that I just showed you. I'm going to show them to you once again. But during the week, I was up as much as $17,375. That was Tuesday of a possible 25. Now, I was looking for 25,000. Wednesday, we drop a little bit. Thursday came. What happened? What did I do? Well, I'm going to show you. I actually ended up getting out early because, again, we could have the best patterns in the world. We could have the best, highest probability options in the world. But sometimes things don't go your way, and you have to take over, and money management then becomes the key. So, Monday morning, here's what I did. I had Google. All right, so to get 5,000 roughly in premium, I sold 5 of the 1,600 puts. They were trading about $10 a piece, so I was filled on those. Amazon, I only had to sell 3 of the 3,300 puts. They were trading at $16.50. That's where I got filled. Facebook, I sold 11 of the 290 puts. Those were filled at $4.70. Apple, I sold 30 of the 125 puts. Now remember, this is after split. Those were traded at $170. And then Tesla, I tried to get filled at $3.55. I ended up canceling that order, and then I ended up selling the 400 puts for $3.40, and I was filled on those. Now, keep in mind, this was Monday morning, sometime around, I want to say about 10:30, 11 a.m. when I put these trades on. All right, Tuesday, things all look good. Wednesday, things look okay, except for one. Tesla, I ended up getting stopped out on Wednesday. And what had happened is Tesla had a big pop down, and it violated one of my stops. And typically what I do with put options is that if I see something go to double what I sold it, that becomes a 1-to-1 reward to risk ratio. I get out. But this one moved so far, so fast, that it blew right through my stop, and I ended up getting an ugly fill. But I was out nonetheless. Here's Thursday morning. All right, so Tesla, look at that. Again, if I back up and show you for a second. So I was in at 340. I was out at 872. Terrible, terrible. All right. How about Apple? I was out at 147. What was I in at for Apple? Well, I sold at 170. And if I sell at 170 and I buy at 147, that's a profit. Amazon, I was out at $6.14. What was I in at again? Remember, $16.50. So I sold at $16.50 and then I bought back at $6.14, better than $10. Facebook shows, remember, I bought to close at $254. What did I sell those for? Facebook, I sold for $470, another small winner. And then finally, you see Google down here? I sold those 5 Google puts for $10. I bought them back for 70 cents. So that was a winner too. So all in all, this is the results of my 25K challenge. Facebook sold at $470 to $254. That was a $2.16 profit. Apple, $170 to $147, small 23-cent profit. Amazon, $16.50 to $6.14. Remember, I sell to open, I buy to close. $10.36 profit. Tesla was my loser. It was my big loser. It was my only loser. $3.40 is what I sold. I ended up getting killed on the buyback, $8.72, down $5.32. Google, $10 to 70 cents. That was probably my best trade when you look at what ended up happening. $9.30 out of a possible 10. So in total, I ended up selling roughly, and these are rough numbers, roughly $25,000 in option premium. I ended up buying back because of the way that I do my money management. I bought back and it cost me $22,500. So my 25K challenge ended up being a small $2,500 profit. Trading summary. Let me just tell you this. Number one, it doesn't matter how great the setup is. Things are going to go wrong sometimes in your trading. It just happens. All right? You can't be 100% all the time, and there are no future guarantees. Number two, no matter how high the trade is for probability, and selling put options has a high statistical probability. It gets higher the farther out of the money you go. But it does come with risk. And no matter how high those probabilities are, there's also no guarantee that they're going to be profitable. And finally, most importantly, have a plan to either have stops in your position, and if you're profitable, make sure you have a plan to lock in some sort of profits, or at least don't let a profitable trade become a losing trade. Hey everybody, thanks again for joining me on this video. I hope you found it educational, maybe a little bit entertaining, but looking through my eyes as a trader, what I did with some short-term patterns from a Monday through, in this case, Thursday. Happy Labor Day to everybody, and we'll see you again next week. Bye now.